Hello friends. So today we are going to discuss about the capital structure or the financial leverage, that how that capital structure will be justifiable and maximize the return on equity shareholders. So this is to be explained through the examples. A example is to be taken to explain that how equity shareholder is getting maximum return by investing more debt funds, that is called trading on equity, and or we can say it is the financial leverage. So that is the capital structure. We can see the capital structure ratio is debt fund by equity funds. That means the proportion of the debt and equity funds investment in the business is called capital structure, and the capital structure should be in such a manner that it will maximize the return to the equity shareholders by giving maximum returns by investing the debt funds. That means the equity shareholder will get maximum profits, maximum returns by investing the debt funds. If you invest more debt funds and less equity funds, certainly there is a financial risk is there, but that financial risk certainly will be minimized provided your return will be high. If your return will be high, we will see in the examples that this capital structure can be also called the financial leverage. That is, the financial leverage is same as the debt funds by total funds investment. That means from long-term sources, the debt fund by total funds, that is equity plus debt funds. That is the financial leverage. So that financial leverage, that higher the financial leverage, that means higher the debt funds in proportion to the total funds, the better, higher the return to the equity shareholders. Lower the debt funds to the proportion to the total funds investment, lower is to the return to the equity shareholders. We have taken three cases. The first case is total equity funds, means zero debt funds investment, that is zero debt, and there is case 2, 1:2, that means 1 rupee is the debt and equity is the 2 rupees investment. Case 3, just opposite of the case 2, that is 2:1, that is the debt will be 2 rupees and 1 rupee will be the equity funds. So these are the three cases we have taken, and the examples I have taken here. You can see the examples. There is the earnings before interest and tax is your 14%. 14% means there is the return on investment, suppose, and debentures, 10% debentures of rupees 10 lakh. So that is the 10% of debentures of rupees 100 each. 100 each. So that is the, and equity shares is 10 rupees per share, and the tax rate is suppose 30%. Total investment is 30 lakhs. So we have taken the three cases. Now we will see that examples so that how it will be, which cases will be better. There is the earnings per share. The cases which give you higher earning per share is the maximum return to the equity shareholders, and the equity shareholders will get maximum advantages by investing the debt funds. Now come to the total, that is your earnings before interest and tax or return on investment, that is 14% of total investment, that is 30 lakhs into 14%, that is 4,20,000. So in the each cases, $4,20,000. Then this is first. So earnings before interest and tax. Then first, second we will subtract less debentures interest, that is 10%. So first case is zero debt funds, that means no interest There is nil. Second case, we are taking 1:2 ratio. So 30 lakhs investment means, that is 1:2 ratio means 10 lakhs is the debt. 10 lakhs that is 10 lakhs is the debt. Here 20 lakhs is debt funds and balance is equity funds. So 10 lakhs debt means 10% is the debentures interest. So 10% of 10 lakhs is 1 lakh. 10% of 10 lakh. So here there is a 2 lakh. 10% of 20 lakhs. 20 lakhs. So there is after, there is earnings after interest, but before tax. This is 4,20,000. This is 3,20,000. This is 2,20,000. Yes. So this is earnings after interest, but before tax. Debenture interest is subtracted. First case, no interest. So 4,20,000 fully to the equity shareholders. Here 10 lakhs is a debenture investment. 10% of 10 lakhs, it is 1 lakh is subtracted. 3,20,000. This is 2 lakh. 20 lakhs is investment. So 10% of 20 lakhs is 2 lakhs is subtracted. That is 2,20,000 left balance. So this is less tax. That is 30%. So 30% of 4,20,000, that is 1,26,000. Yes. So this is 96,000. There is 66,000. So there is tax 30%. So profit 4,20,000 for profit, 1,26,000 tax. Here 96,000 tax. Here 66,000 tax. You see the difference of the tax decreases if your debt fund investment is increases, because the debt fund investment increases means debentures that carries with the interest is a tax reduced profits, that your tax is reduced. Then this is earnings after interest and tax, that is 4,000. 2,94,000. This 2,24,000. $1,54,000. This is the profit available, earnings after interest and tax. This is profit to equity shareholders. So number of equity shares here is up to this 10 each. So this is 30 lakhs. Total investment is 30 lakhs. So 30 lakhs is fully equity shares. So 30 lakhs divided by 10. This is 3 lakh equity shares. This is 10 lakhs is debentures. Remaining 20 lakhs is equity. So this is 2 lakh equity shares. And this is 1 lakh equity shares. So now earnings per share is earnings after interest and tax divided by number of equity shares equal to here this for sale. So here it is 1 2 for sale. So here it is 1.54 for sale. This is maximum. So the three cases. So this is 2,94,000, 2,24,000, 1,54,000 profit available. So that is the number of equity shares here 30 lakhs total equity capital divided by 10 3 lakh equity shares. Here 20 lakh equity capital divided by 10 2 lakh equity shares number of equity shares. Here 1 lakh. So there is 10 lakhs divided by 10 lakhs divided by 10 that is 1 lakh equity shares. So now the profit is this is number of equity share is this earnings per share that is earnings after interest and tax divided by number of equity shares. So 2,94,000 divided by 3 lakh it comes 0.98 paisa per shares. So here 2,24,000 divided by 2 lakhs becomes 1 rupees 12 paisa per share. So here 1,54,000 profit is less, also the number of equity shares equity capital investment is less, that is 10 lakhs, that is 1 lakh equity shares. So getting 1 rupees 54 paisa per shares. So this is maximum advantages by the equity shareholders when the equity shareholders take the advantages of more debt funds and less equity funds investment. So this is the maximum advantages. So as we are increasing the debt funds, the tax rate also reduced, the tax liability also reduced for the companies. This is happened provided your return in earnings before interest and tax is greater than rate of debentures. This is possible if the earnings before interest and tax is less than rate of debentures. Then what it happens? If you take it, that is the debentures interest we are taken here 10% and the rate of investment is 14%. So instead of 14% we will take that is 10%. Suppose that is 9%. We can take 9% alternative cases. So same cases instead of 14%, this is 9% of 30 lakhs. That is instead of this 2,70,000. 2,70,000. This is 2,70,000. Now that is debentures is 10% of 100 rupees is. So here debenture interest is nil. Here debenture interest is 1 lakh. Here debenture interest is 2 lakhs. So profit after this is 2,70,000. Then here not 3,20,000. This is 2 lakh, 1,70,000. So here only 70,000. So your tax liability is also reduced 30% of 2,70,000. That is 81,000. This is 51,000. This is 21,000. So after tax profit is here. This is come here. This is 9 and 1,89,000. So here there is 1,89,000. 1,89,000 1,19,000. So here it is 49,000. So profit is reduced. So number of equity shares is 3 plus. So that is here instead of this, it is coming. Alternative is that is 0.63 paisa per share. So here it is coming. That is less than that. This is 0.59 per share. So here it is coming 0.49 per share. That means when your debenture interest is more than the return on investment, their equity funds is better. Debt funds is not preferable. So when rate of investment, the return on investment or the earnings before interest and tax rate is more than the debenture interest, then you have to choose more debt fund instead of more equity funds, because more debt funds will help you earning maximum advantages trading on equity to the equity shareholders, provided your market rate of debentures is less than your rate of return on investment or earnings before interest and taxes. If your return on investment is less than the rate of interest of debentures, debt funds, then certainly the debt funds should not be choice as preferable source of funds for the capital structure. So this is what you had understood, the maximum advantage of how trading on equity is to be achievable, and hope you will understood it, and this will help for your better preparations. Thank you.